Have you ever stopped to think about what really makes the global economy tick? You know, that invisible force that lets you sip coffee from Brazil or use a smartphone built in China? Well, today, we're pulling back the curtain on Forex trading. It might sound super complex, but trust me, it's a lot closer to your daily life than you think. Let's get into it.
Okay, just to give you a sense of the sheer scale we're talking about, I want you to think about this for a second. What do you think is the single biggest financial market on the planet? I mean, bigger than the New York Stock Exchange, the London Stock Exchange, and the Tokyo Stock Exchange, all added together.
The answer? It's the foreign exchange market, or as everyone calls it, Forex. And get this, we are talking about an absolutely staggering $7.5 trillion being traded every single day. That's more than the entire yearly economic output of most countries on Earth. It's a number that's almost hard to wrap your head around.
So what is this colossal market that makes everything else look small? Let's break down the absolute basics. The best way to picture Forex is like a giant, non-stop river of money flowing all around the globe. It's not one physical place like a building downtown. Nope. It's a massive, interconnected network of banks and institutions, and because of time zones, it literally never sleeps. It's open for business 24 hours a day, 5 days a week.
And here's the thing. You've almost definitely been a part of it, probably without even realizing it. Have you ever exchanged your money to go on vacation or bought something online that shipped from overseas? Yep, you were participating in the Forex market. It's the engine that quietly powers the whole global economy.
Okay, so if we're going to understand how any of this works, we have to start with the most fundamental building block of a trade, the currency pair.
See, in Forex, you never just buy or sell a currency by itself. It's always in a pair, because you're always exchanging one for another. Just think of it like a price tag. The first currency, the base, that's the thing you're buying. In the second currency, the quote, that's the price you're paying for it.
This slide just nails that whole dynamic. It's like a constant economic tug of war. So when you buy the Euro-USD pair, you're not just buying euros. You're basically betting that the European economy is going to get stronger compared to the US economy. You're picking a side in that tug of war. All right, like any industry, Forex has its own lingo, but don't worry, you only need to know a few key terms to really get what's going on. These next three are the absolute essentials. First up is the pip. This sounds technical, but it's really simple. Just think of it as 1 point of movement in the price. So if a currency pair moves from, say, 1.1050 up to 1.1051, that's a 1 pip move. It's this super tiny little measurement that ends up determining your profit or loss.
Next, we've got lot size. This is just a fancy way of saying how much are you trading. Now that standard lot number, 100,000 units, sounds huge, I know, but don't let that scare you because pretty much all brokers now offer mini and even micro lots, so you can trade much smaller amounts.
And finally, leverage. Okay, this is where things get really interesting and also pretty risky. Leverage is basically your broker letting you borrow money so you can control a much bigger trade than you could with just your own cash. It's a tool that can seriously magnify your profits, but, and this is so important to remember, it works both ways. It can magnify your losses just as fast.
So let's put it all together. This slide shows a perfect, simple trade. Step 1, you've done your homework and you think the euro is about to get stronger. So step 2, you buy the euro-USD pair. The market moves in your favor. The price goes up. Step 3, then step 4, you sell the pair to close out your trade and you lock in that profit. Those pips you gained are your earnings.
But what makes these prices move up and down in the first place? It's not just random guesswork. There are some really powerful forces driving these changes. At the end of the day, it really all boils down to supply and demand, and that demand is driven by a few key things. You've got huge factors like a country's interest rates, big economic news announcements like job reports, and of course, political stability or instability. And sometimes it's just about what traders think is going to happen. I absolutely love this quote. A nation's currency is the report card of its economy. It just sums up the whole idea perfectly. If a country's economy is strong, stable, and growing, investors all over the world are going to want to own its currency. It's that simple.
Okay, we've gone through a lot, pretty quickly, but if there is just one single idea that you take away from all this, I really hope it's this next one. See, here's the big picture. The Forex market isn't just about charts and squiggly lines on a screen. It's so much deeper than that. It's like a constant 24/7 conversation happening between all the world's economies. And the currency prices? Well, that's just what they're saying to each other.
And that's really what I want to leave you with. Now that you've got the basics down, can you start to see how a big news story from halfway across the world, maybe an election in France or a policy change in Japan, could actually have a ripple effect that touches the money in your own wallet? That's the real power of understanding Forex. It connects our amazingly interconnected world right back to you.